Thank you for joining us for our second quarter 2024 financial market update. I'm Jeff Schmidt, Director of Investments at Vision Capital. The overall message halfway through the year is that higher interest rates and a shrinking money supply is beginning to slow the economy after several years of strong economic growth. Real consumer spending is falling, and government consumption expenditures are slowing. These factors serve to reduce aggregate demand and weaken the overall business environment. Companies are posting lower employment vacancies as strong gains in new jobs are not being backfilled at the same rate. The ratio of job openings to job seekers is nearing pre-pandemic levels of 1.4 versus nearly 2 jobs for every available worker in early 2022. Furthermore, the quality of labor market gains is questionable. The economy has not added net full-time jobs over the last 2 years, despite adding hundreds of thousands of jobs per month. This means nearly all the gains have been for part-time work. Normally, strong economies are supportive of permanent, full-time labor demand from businesses. Sharp improvement in the rate of inflation throughout 2023 began to stall by the end of the year. Very little improvement was made through April 2024, but price levels began to react to the weakening environment in May and June. Declining excess personal savings and unchanged short-term interest rates will further pressure aggregate demand through the remainder of the summer. Activity in U.S. markets this quarter were like the first 3 months of the year. Large cap stocks gained another 4% on top of over 10% in the first quarter, while small cap stocks fell 3% after posting a modest 2% gain earlier. But even within large cap, the enormity of the gains were experienced by a very small number of very large market cap companies. The S&P 500 index at equal weight fell nearly 3% in the quarter, just like small caps. Slide 7 describes this phenomenon perfectly. If we divide the equal weighted value of the S&P 500 by the normal market cap weighted value, we see the relative disposition between mega market caps and other large caps. The only other time this ratio was lower was during the Great Financial Crisis, which provided an excellent opportunity to buy small caps. This chart shows this discrepancy on a price-to-earnings ratio basis. Large cap stocks are the most expensive versus their expected earnings when compared to small caps in at least 20 years. Much of the optimism in mega cap stocks is due to future earnings growth from AI. This idea implies that AI will bring a productivity or revenue boost to the rest of the world's companies, motivating them to consume the technology. It cannot be the case that those companies selling the technology receive a durable financial benefit while those consuming the technology are adversely affected. Our outlook includes 2 paths. The most likely path is the proverbial soft landing, which is characterized by mild economic output, no material job losses, and core inflation sustained at 2%. A less probable but not insignificant likelihood is a contraction, characterized by negative economic output and meaningful job losses. Financial markets vary in expression of these 2 outcomes. Both scenarios are visible depending on which areas of stock and bond markets one observes. A soft landing avoids a recession while still ending the natural economic cycle. In this case, the Federal Reserve would lower interest rates and a new economic cycle would begin. Credit extension and increased aggregate demand would benefit a wide range of companies and would change how stocks are priced. This was the main idea behind our decision to increase investment in small cap stocks late last year. We understand many people are concerned about the financial market impact of the November 2024 election. Fundamentally, financial markets are a function of future expected economic growth and how that growth translates into corporate earnings. The results of any one election are rarely, if ever, the catalyst for drastic, long-term structural economic change. This page illustrates this concept by showing that invested capital is awarded through time, not because of any one or series of elections. Thank you for watching, enjoy the summer, and we look forward to speaking with you next quarter.